Welcome to the Real Estate Podcast with Robert Ikard. It is June 10, 2022, and this is episode 6. And today we have a special guest, Jason Yarusi from Tennessee.
I'm good. How are you?
Good. How are you doing today? We talked
I'm really good, man.
We talked a little bit earlier, and I see the family photos and coloring behind you. I like to see that.
Thank you. Thank you. Yeah, they keep things moving for sure.
So, Jason, people want to know who you are, but what I'm going to do is I'm going to read a small biography of you.
Cool.
For the guests. So you are the founder of Yarusi Holdings with your wife, Pili. You have acquired $100 million in real estate across 1,100 multifamily units since 2017. Very impressive. He's an average.
Yeah, it's actually they must have hit you with based on whenever we schedule this an older one. We're about 160 million off for about 1,400, 1,500 units right now.
Well, my goodness.
Yeah,
that's a jump up. All right. Well, thanks for the correction. You're an avid ultra runner. Are you still that?
I run more than I don't run. So yes,
Okay.
sir.
Okay, good. Just checking, making sure you're still working out. You're a workout enthusiast. You host the Multifamily Live podcast and the Jason and Pili podcast project, which is also a podcast. You wake up daily at 4:32 a.m., is an aspiring ukulele player, and most importantly, father to 3 amazing kids and a husband. So Jason is an active real estate syndicator and real estate investor. Jason and his wife founded Yarusi Holdings, and we just talked about how many units they have. And he hosts these podcasts that we talked about, and he has started and exited multiple businesses in the past 15 years. And his family construction business has a niche industry position in raising and moving structures. The company has elevated over 2,000 homes in the last 7 years alone. Beyond real estate, Jason spends his time with his wife and young kids, Luke, Lily, and Leo, and is an avid CrossFitter and now lives in Tennessee. So, Jason, what I like to ask my guests is what I would like to ask you especially is how did you get involved in real estate?
Sure. So real estate itself, we ended up coming from a number of different facets, right? Back in, we'll say, early 2000s, met Pili, my now wife, first time. We actually met working at some bars in New York City. We were in the bar and restaurant world for a number of years. Pili had moved out to LA, moved back to Hawaii, where she grew up, all before coming back to New York. I opened some bars there, opened and sold a brewery there, opened some restaurants. But then Hurricane Sandy happened, hit New Jersey, a lot of the East Coast really hard. My dad, as you did mention there, has a niche construction business where he lifts and moves homes. Typically, he'd do about a dozen projects a year, right? You look at the fraction of who needs work lifting and moving a building. Well, those couple calls he would get a week went to hundreds and hundreds of calls daily. My brother was working, younger brother was working for me at the time. Pili, my girlfriend at the time, myself, we moved out to New Jersey to help dad, moved out there to help him really push forward with just the influx of work, and was great. We helped dad for a couple of years, but it was never really my direction in life. And we learned another lesson, just noting activity or service businesses, right? You have to do to make, right? So the bar world, restaurant world, construction world, all of that narrative there, just said it wasn't a path for us. We wanted to find time to be able to control the day, to spend time with our kids. And all this activity was actually leading us further from it. Came upon real estate. We thought we were doing what was logical. Pili, now pregnant with one of our kiddos, started getting a real estate license, and we started flipping houses. And what we learned quickly is that, again, we were adding a lot of active stuff on top of already being busy helping dad and all this other things. That led us to do flips, wholesales, some short-term rentals, a bunch of other projects before finding out-of-state rentals. And this was the aha moment, just understanding that we could put what's worked for us in the past, just putting in good practices, proper management, and it allowed us the scalability to just really control our days. And that led us into large multifamily investing, which we really started in 2017 by buying a 94 unit in Louisville, Kentucky.
Okay, now I saw the word syndication. And for the benefit of our guests that do not understand that, why don't you, as the expert, explain what syndication is?
Sure, great question. So you can syndicate many things. You've heard syndicated television shows or real estate or radio stations here. It's a way that you can pool resources from others to buy something large to all benefit from the economies of scale, or buy something in where you can all benefit from the pooling of resources. And so how we use this for real estate is that ourselves and our partners, we all pool our capital, right? And it started as a group of just friends and family. It's now grown out to a larger base of investors. We pool our capital to buy larger pieces of real estate where the money that comes in will fund the down payment, closing costs, the construction money, and any fees involved. And we partner that with debt to be able to buy these larger properties that when you buy a larger real estate property, you are afforded many benefits that come with owning a larger property compared to a smaller property. And syndication allows us where potentially if it was only our own money, we may be capped at the size of building we could buy, and that may limit us on the economies that we can get from that smaller property.
So now, as a syndication, how are the properties, what is the structure you used to set up the different entities?
Sure. So we buy every property. Yeah, we buy every property under a new entity. So if we were buying another one coming up here, we would set up a brand new entity, 123 Main Street LLC. That's going to be the entity that's going to be a single asset entity that controls the property. Within that property is going to be, it can be many classes, but typically to keep it simple, we're going to have two different classes, Class B members and Class A members. We will be under the Class B members as the managers, operators, all the ones of the active components there. We are going to carry all the rights to run the property. We are going to sign the debt. We're going to do everything to the point where we will put together the business plan, raise the capital, carry out the business plan. We will be under Class B. Under the Class A members, that will be all the passive investors who will solely be in there in a passive environment that are looking to invest solely there, that will not have to sign the debt, will carry no responsibilities throughout the property here, and will have no expectations to have to do anything as part of the operations, and will solely looking to get a return from their investment.
As well as no authority as well. Is that correct?
So yes, they would have limited voting rights. However, this depends how you write the operating agreement. So you can write the operating agreement that they do, they don't, but on that front, They will have voting rights at some point, but typically they will not carry more than 49% of voting rights.
Okay, so I assume you appeal to people who say, I don't want to be dealing with toilets at midnight. I'm sure you've heard that question before, or that. Is that correct?
It goes to all points, right? It's looking for people that, one, we have some friends who are operators that will invest in us, whether it's just us as management or trying to diversify across, the places they're investing. You have people that would love to do it, but just, make a lot of money, doctors, dentists that just don't have the time to do it, right? Or just don't have maybe the knowledge. You have other people who have only been exposed to the stock market, and this is a way for them to offset some of their, potentially their tax exposure. And then you have others who typically would love to do it, but then find out that it's a lot of work and would rather sit on the sideline and just invest with someone else who's done the work to be in a good position to run these assets. Now, we ourselves are not out there actively fixing toilets. We use a third-party manager in each market we're in. Majority of our markets, Nashville MSA, Atlanta MSA, and Louisville MSA is our prime markets. We have properties or have had properties in other ones as well. But there we have a group who is a property management company in each market that handles the day-to-day operations. How we, after we close on the asset, we handle the asset management, which is mainly carrying out the responsibilities of making sure the business plan is implemented and continue to be implemented throughout the life of the hold of the property.
And I'm sure with your expertise, you are able to make sure that the property management companies are doing what is expected of them.
Checks and balances, right? Any good group can become bad or can become good, right? There's always different levels, but you want to have checks and balances. We do weekly calls with the property management company to make sure the plan is going as processed. You can imagine if you buy something that has 50, 100, 200, 300 people living in it, that the plan will pivot, right? That things change with it, with a bunch of living people. So we can constantly keeping our head on the swivel with the business plan, tracking it back to the pro forma, making sure we are proceeding in the right way and changing the process if need be.
Okay, Jason, just some questions that pop into my head. Do you focus on any particular geographical area?
Nashville, Atlanta, Louisville. So we like that thorough way right there.
You said Atlanta?
Atlanta. Yep.
Oh,
Atlanta,
okay.
MSA.
That's quite an area.
You know, there's good spots. We've sold out of a couple properties there. We have a couple now over in the Decatur market that we've taken on recently, less than the last 12 months, that we're in a good part here. A lot of growth in those markets. I've walked in those markets with our rents actually above pro forma, which has been really nice. Same thing with Nashville, supply constrained market, a lot of room to grow in these markets. However, product hard to come by, which you're seeing the price point. I've sold out of Louisville a bit. We have one property left there. Just for instance, just the market has gotten so aggressive. So we've decided to move out of a lot of those properties just based on how far ahead on the business plan we were.
What do you mean aggressive?
So as you've seen, just with the move into multifamily during COVID and others, where it became a safe haven, right? From retail and office being more exposed, the work at home environment, we've seen a lot of capital going into multifamily. And as you see that, you look at that, it's pushed our product to another level. We've seen cap rates compress. We were in a very low interest rate environment for a number of years here as we look at it. And we've seen that housing has become hard to build based on the cost, based on the lack of labor. And we've seen that the supply go to record heights, noting that we've had such a move into a lot of these markets too. We've continued to see rents trend up in a great way too, where we have couple properties even here in Murfreesboro, we're at this time 100% occupied with really no move outs on the agenda. We have waiting lists, right? And we continue to increase rents ahead of where our pro forma rents are based on where we would be at that year.
Well, the company I work for, I mean, I have personal real estate, but I also work for a company and we do residential, but mostly commercial. And I'm in Dallas, Texas, and it has gotten crazy in terms of, I'm afraid to even make a waiting list because I make people mad. We've got people pouring in from California, but it just seems like to me, and I'm jumping around a little bit here, but the thing is, getting back to multifamily and housing. That's how I got my start with apartment complexes. And I always found that to be a great investment because, a lot of people will have standalone, let's just say, I jump back from commercial to residential because I have a lot of experience in both. But for example, if you have a large retail or commercial building, it's kind of it's win or lose. In other words, it's either rented and you're doing well, or it's empty and you're suffering.
Yeah, especially if it's one tenant or not, right?
Exactly.
And the longer leases, right? That's what makes multifamily adaptable, is short leases, right?
Yes, short leases. And what I've always liked about it is I've always kind of liked the idea, and this applies to commercial too. You can have this in commercial as well. Is I'd rather have 10 tenants than one tenant.
Yeah.
As a personal matter. I mean, can you expand on that point a little bit? I think you know what I'm talking about. I'm sure
it comes down, like, you can look at space to space, right? The office space, right? Typically It's going to be tenant credit. It's going to be they exposed to something like Amazon, where they're going to take it out, where they're not service oriented, right? Where they're going to have a hard time competing with just the leverage that those bigger companies have. But on the multifamily side, it's the same thing, right? You see, lots of times the narrative is, oh, bigger is more risky. But if you look at it and actually take back that thought track and say, well, is it really? Because if you have a 10-unit building and you're 3 or 4 units vacant, right, you're at 60% occupancy. Maybe you're not even able to pay your debt service and afford the property. But if you have a 100-unit property and you're 3 to 4 units vacant, you're at 96, 97% occupied, right? So your ability to push forward, to spread out your risk across having so many tenants able to come forward to be able to pay for your pay rent, to pay for your mortgage, to pay for your expenses. And then you can have a full-time staff afforded by the property where you can run it more like a business, right? Where you're buying real estate in a smaller capacity. It's harder to run it like a business. It's less efficient because, say something breaks, where you have to call someone, have them go out there, look at it, figure out what the parts are, run back, compared to just having on site who can run it and operate it on a day-to-day basis and plan out for the improvements that need to be made, or prepare for any CapEx or other points based on just common upkeep to the property.
Well, tell me this, Jason. I'm kind of gotten away from the residential world a little bit because I'm mainly doing commercial. But it's my understanding that a lot of these big institutional investors are buying single family homes, and I assume they're aggressively pursuing apartment complexes as well. Is that correct?
It is. The next piece is you see an aggressive buy box for these groups on single family homes, but they're doing it in planned communities, right? They're buying scale, buying 20, 30, 100, 200, 300, rent, build to rent communities, right? And they're doing that because they get the scale. Plus, on the single family space, it gives you some options that maybe on the multifamily side you don't have, right? Tenants will carry a lot more on the part of just everything, could be from lawn care to just expenses to paying for their own utilities, right? So your expense warranted may go down a bit. Plus, you have the advantage where potentially you can offset your risk by selling a house off at a time, right? So there's an interesting scenario. We've seen a lot of that move up. But again, it goes to the point, are they competitive in the multifamily world too? Yes. But it seems like a land grab right now, just based on how much is how limited we are in certain areas based on housing and how hard it is to build. So the more you can accumulate, the better we can really track with really keeping up with all the things that real estate afford us.
Yeah, I've noticed here in DFW area, there's a push out in every single direction, north, south, east, and west. And we're Dallas, Fort Worth. It's a humongous area. And what's happening is that they're pushing out so far. Okay, so that's one thing. They're pushing out really far with a lot of these housing, but on the other hand, it's kind of tough when you live an hour and a half away from where the jobs are. Yeah. If that makes any sense. I mean, are you seeing that in these areas that you're investing in?
So there's just so much land mass in some of these areas, like a Texas, right? So you can keep building, but you said the piece of the puzzle, right? It's jobs, right? So it goes, there's the point of how far will people travel to live affordably? Because there's that rate here where we can have price inflation, but we have to have wage inflation to keep up, right? So if you live 2 hours from Dallas, are you willing to drive to Dallas, or are you going to try and find a job out where you are that may not pay you the level for which you feel you're warranted to make, right? So there's less potential in some areas, right? Like you're space constrained in markets like New York City, your Miamis and stuff like that. Nashville, we've seen it grown a lot, so there's a lot of room to grow, right? And it goes out with the same narrative, right? If you're 2.5 hours from Nashville, are you reasonably driving that every day? Probably not.
Especially one way.
Especially one way, right? And people do that to live in New Jersey, right? They may sit in 2.5 hours of traffic, crazy enough, each way to go into New York City because of how much value, the higher price may pay. So easy enough, they may sit through that pain day in and day out, even though you could be 30 minutes from New York City and 3 hours of traffic, right? So you have to think about the piece of the puzzle there is that what's the trade-off, right? Time versus dollar.
Well, maybe that's why we do these podcasts, so we can give them something to do on these commutes.
No, that's it, right? He's 100% right. I'm sure they got to be doing something besides pulling their hair out.
Right. No, but it's true. I do think a lot of people listen to podcasts while they're driving. So one thing you didn't mention is gas prices.
Yeah. Well, you throw that in the mix, like that's a whole nother thing, right? And that you opened up a whole can of worms there. Is that okay? Cool. You get cheaper cost of living, and now you're an hour and a half away, and you're going to drive up there. If you do factor in how much more expensive it is to travel every day, right? And does it actually make sense to do so, right? Could you just live closer, right?
Right.
Not have that, and then even if you're paying more, are you actually paying more when you break it in? And I don't know, most people aren't like yourself, who's really probably paying attention to that. A lot of people aren't paying attention to that, so I don't know on the front how many people are actually sizing out their budget. Probably not that many, until they realize, they get home every day and say, well, there's no money in my pocket.
Well, the thing is, the gas prices, it's shocking in the last, whatever, 20, at least 12 months, or you talk about 24 months. It's just, it's shocking, and it's changing people's lives. It's changing people's lives in a lot of ways. That 2.5 hour commute now becomes a real deal.
I was in Georgia 2 days ago, and here in Tennessee, it's like 4.5, 460 over six something dollars. It was I
paid $4.75 here the other day.
Yeah.
And that's just for regular unleaded. That's not even
same here.
Super or anything like that. So yes, now let me step back from this. People have a choice where they're going to put their investment dollars. Okay. Do you see people ever using their IRAs to come into your investments?
Oh yeah. We get
Tell us about
individuals, business, IRA, trust, solo 401ks.
Tell us about how they can use their 401ks and their IRAs to get involved in real estate.
Sure. So little known part is that your IRA, depending on how it's set up here, can be set up that you can direct how it's invested. However, a lot of groups where your IRA is, you may ask them like, hey, I'd want to self-direct it. And they may say 100% you can, but it's only into these asset classes. So you're really not, you're just doing it. So if you have certain ones, it'll
be a small family of mutual funds.
Correct. Yeah, correct. Right? Here's my thing, right? But there's about 50 or 60 groups out there that actually allow you to fully self-direct it here. And what you can do is you can actually direct that into real estate, right? Into different investments here.
Now, what do you mean by groups, Jason?
There's different providers out there that they basically are self-directed providers for IRAs.
Okay.
Where you can roll over from your current IRA to them as a custodian, and they allow you to, or they have the options to allow you to invest openly into investments that would warrant investing to an IRA.
Would you be able to help anybody with a list like that?
Oh, there's Advanta, great one, great response. There's Equity Trust, there's Next Generation, there's Cama Plan. Those are the ones. I'm working with 2 of them right now on an investment. So they're all good groups right there to reach out to. Most should be pretty serviceable, right? It just comes up from us as the sponsor side. Typically, it just comes out that what would happen, instead of the investor themselves investing directly into it, like whether it's their business or that, they're basically controlling the side. The money's going to go to the IRA. The IRA is going to be the one who is investing, right? So they're going to be the one investing. So it's going to be investing on your behalf as you, who controls your IRA, but it's your retirement account who will invest into it. So typically, this provider will be placing the investment with the syndicator.
Now, the reason I'm drilling down a little bit on this, Jason, is I do have stocks in the stock market, but I try not to look. Especially lately. I can't avoid looking. We have it on at our office.
Yeah.
We have a CNBC on at our office every day, and so I glance at it every now and then. So, I mean, let's talk. You're definitely a real estate guy, okay? Tell me what your opinions are. Stocks versus real estate. You may not know a lot about stocks. You may know a lot. I don't know, but just kind of just give us a brief rundown. I've been dying to ask you that.
I have stocks, I have crypto, a lot of info on real estate. It's all the piece of the puzzle here where you have to say, where do you want your money, right? If I'm not going to be an active trader in stocks, that's not where I'm going to be, right? If I'm going to invest, it's going to be in the stuff that I'm okay, dealing with the uncertainty, right, over the time and just finding a part. What you find is that when it's a risk-off environment, you have a lot of people that will take their money out of real estate or out of stocks and out of crypto because they're intangible assets, right? They're things that are they could go to zero and just because, right? Bad news, bad events or anything. Typically, when you move into real estate,
how often do you see an apartment complex go to zero?
It has some kind of inherent value. Right. And that's why it doesn't. It's very hard to see it go to zero because you have land, you have a building, right? So that's why people will move into real estate because typically, although you may see dips in value, it's hard to ever see it go to zero, right? You have to say the land, the building itself is going to carry some kind of value. And when you
I have seen stocks go to zero because of a scandal with one of the executives.
Correct.
At a company. You don't really see that in real estate, do you?
It's tangible, right? And so at some point, even if the building, for whatever reason, got knocked down, the land itself is still going to have it. Like it's going to be hard to establish a point where it's worthless, right?
And you can insure that building.
Correct. And that's why the part, and you can use leverage, right? Use other parts to bring down your cost of capital, right? You can get more with your dollar. And the same thing, even in a high inflationary environment, it tends to fare better. Now, different asset classes will tend better than others. Multifamily is one of those, right? We talked about the adaptability with the short-term leases, but typically the cost to build, hard for labor, with all the rising costs right there, it ends up, and the more dollars out there, it's going to bring your building up, right? But ultimately, when you go to say, you have your tenants who are again now paying down your mortgage, but we're paying in nominal dollars. So although there's more dollars out there, you're still owing your same dollar amount on your mortgage, right? So it's actually helping you in both ways. And if you see a point where if you have $1 million building, you have say for easy math, $800,000 loan on the property, and you see a 50% rise in inflation over a couple of years, like crazy as it is. And that 200,000 you put down is now worth another $100,000. Well, that debt you have, they're not asking for another 50% inflation on that debt. It's the same nominal dollars, right? So you're able to benefit from the inflation that happens as well in this environment, which makes real estate an interesting use case. Plus the fact your tenants are paying down your mortgage, you can have the ability to have a cash flow stream. You can have appreciation that either happens just because of the market, or you can force it forward based on improvements to the property. You can get diversification because you can be in different markets. You can use leverage to your advantage, get the tax advantages because the government's not good at managing housing, using depreciation, cost segregation to take advantage of forcing forward depreciation. With stocks, it's up or down, or how to trade and can leverage on some of those points there. But then there's just the unpredictability, like you just said, of scandals and other things that you can't foresee, right? So here, multiple options for you to use real estate to help you, depending on who you are, right? And you can win in many different ways.
Well, Jason, here's a question I have for you. These rising inflation and rising construction costs, what are you seeing about new multifamily units coming online? What are you seeing about the costs of building them?
So, something in Nashville just traded new construction ground $470K a unit. It's just like nuts.
So say that again.
It sold at $470K a unit, just built, not even leased out. Right?
Are you talking about apartments?
Apartments.
Yeah. Wait, I'm sorry. I'm having to digest what you just said.
Well, so
Wow.
typically, yeah, like, we're buying in place assets, 80,000, 100,000, 150,000, 200,000, right? So if it cost to build, say it was, 350,000, and I could buy something relatively in good shape for 200,000, put even
Per
50,000
unit.
per unit. Yeah.
Okay.
So if I can still do that, it makes a lot of sense, right? And so because the cost to build is so prohibitive. But now, if you can build a 350,000 all in for a unit, right? I'm just throwing easy numbers out there, and you can make 470. It drives people to want to build. And when you look at how little supply is and how much demand is, it makes all the sense. The harder thing here is that, right now for, let's say, infrastructure, you may be 4 months out in supply on materials. So, and labor may be ridiculously difficult to get. So
I've seen that here in Dallas, big time.
Correct. So your question would be that even though, like, man, we should go out there and build, like if we want to build, we may not be able to find the space that's zoned correctly. We may have a long entitlement process, and we may have very difficult time having supplies when we want them and having the labor pool to do it, right? So although you could say, yes, there's a case study for saying, yeah, let's go build. Well, just because you want to doesn't mean you can.
Economically, right?
Correct.
Okay, so let me ask you this. Let's step back. I want to get a kind of a big picture as we wrap things up. I'm seeing some trends, overall trends, and I want to pick your brain a little bit for these trends. I guess what I'm seeing right now is a lot of people, a lot of young people. I'm seeing a couple of trends that I've seen. A lot of them are renting rather than owning. Owning is very expensive. It's gotten really expensive in a lot of places as far as just gathering the down payment. Dallas is just going crazy. The property values for single family dwellings. And then, so I'm seeing that trend. I'm seeing them want to take young people. Many times I'll see them take Ubers and Lyfts rather than owning a car. So I'm seeing where they're making economic choices where I can see it benefiting multifamily investors a lot in the future. Do you understand what I'm saying, or can you see these trends as well?
Yeah, so I'm forgetting if whatever it is, Gen what, but the 20 to 29-year-olds is the largest portion of in history. 52% still live at home. World War II and Great Depression, it was like 42 and 48%. So all those people are going to move out, but then they're not going to be able to afford a house, right? With the interest rate rise up, I think about a year, even like 6 months ago, like if you could afford like $2,500 payment or something like that, you get like a $350,000 house. Now at that same rate, based on where the rates jumped up, that $350,000 house is like $270,000 of the same house at that payment.
What's the 30-year rate right now?
It's 5, so over 5, right?
Yeah, that was basically what it was the last time I checked. It was
getting
close to that.
Yeah, and so in that fact, you look at that and you say, okay, well, say they're ready to go out there and buy. Well, now the houses keep going up, right? It hasn't cooled off that much. They can afford less house. There's no houses. So they're like, I don't want to live with mom and dad anymore. I'm ready to move out. But there's a windfall of all these people who have been living at home. They want to go find it. Like, I want to at least go live somewhere cool, right? So I'm going to live places where I can get places and be around stuff, have the walkability. I'll take the Uber. Hopefully that will help, because then I don't have to worry about paying for car insurance and all this other stuff. When I lived in New York City, I would have never had a car. I still today, I'm here in Nashville. You got to drive places. If I could never drive again, I'd be cool. I spent 12, 13 years without a car. I was fine.
Well, when I travel to another city, I don't rent a car.
Correct.
I quit doing it. I just take Uber and Lyft.
Correct.
Mainly Lyft, but yeah, it's so yeah, it's interesting, the trends that are happening, but I think these trends are favoring multifamily, wouldn't you say?
Oh yeah. It's going to continue because people want the flexibility to be able to just pick up and go. Like you got a year lease, okay, I'm out. Like I want to go live in Phoenix. Go
right.
ahead. Like I lived there a year. Okay, I want to go live wherever. because now, especially if you can be less market agnostic and just your job allows you to work from wherever, well, now you can experience more because you just get on this magical thing called the internet and just work from wherever you want.
Okay, very quickly, tell us how you raise money without asking for it. I saw that on one of your materials, and I want you to let us know as a final thought how you do that.
No one ever wants to be put in the spot and have to make a hard decision. And it's not fair to them either. So the way that we do that is we go out there and meet people who are looking to invest and explain to them what we do prior to having investments. Because when you have an investment now you need the capital because you have to meet your timelines, you have to know them apart. And it's not fair to you if our first conversation to explain, who we are, what we do, why we do it, why we like this space, why the returns are great, how it's structured out, and the actual investment. Hey, do you want to invest with us right now? Right? That's just not fair to people. It's too much. And they shouldn't have to make a choice like that. Plus, we want to make sure this is going to be good for them and what they're looking to do, why they want to invest. So if I can bring you ideas about, so our first deal, for 5 or 6 months before we found it, we were out there talking to our friends about why we're investing in real estate now. Before, remember, we were into restaurant world. Here's what we're doing. Here's the type of property we're going to find. Here's what the returns are going to look at. What do you think? Is this something you might be interested in? Yes or no? Great. Well, yes. Okay, would you think about investing 25,000 or 50,000? But then they can go away and think about it because it was almost like a simulation of what we're going to do. So, and then when we would have a deal, we get a deal and we go back 4 or 5 months later, we have the actual deal and we raise the money within a day because we've already done the work to allow them the proper time to understand the investment and see if it's going to be something of a good fit for them.
That is nice. And thank you very much for taking the time to visit with me tonight.
Thank you.
And I'm sure everybody's going to enjoy listening to this. And I'd like to talk to you again in the future. I feel like we didn't cover enough.
We sure covered a lot. So I really appreciate you having me on. Thank you so much.
Thank you so much. Talk to you later. Bye-bye.
Talk to you later. Bye.